When the conversation turns to ESG investing, most people instinctively lean toward emotion before understanding. You can hear it in the questions they ask. Is this about doing good? Does this mean lower returns? Is this just politics entering finance? These reactions are understandable because ESG sits at the intersection of money values and responsibility. Three things that people rarely separate cleanly. But before judging whether ESG investing belongs in a serious portfolio, it is necessary to slow down and understand what role it is actually meant to play. Not in theory, but in the real world, where capital is exposed to risk incentives, shape behavior, and markets eventually punish illusions. ESG investing at its core is an attempt to widen the lens through which risk and value are assessed. Traditional financial analysis focuses heavily on revenue margins, balance sheets, and growth projections. These are essential, but they are incomplete. ESG asks a different question alongside them. What hidden vulnerabilities or strengths exist outside the income statement that could materially affect long-term outcomes? Environmental risks can destroy assets, disrupt supply chains, and trigger regulatory backlash. Social failures can erode trust productivity and brand equity. Governance weaknesses can turn profitable companies into case studies of collapse almost overnight. ESG does not replace financial analysis. It challenges it to be more honest. The rise of socially responsible portfolios did not happen because investors suddenly became idealists. It happened because ignoring these factors proved costly. Scandals that wiped out billions, environmental disasters that bankrupted companies, and governance failures that shocked markets were not acts of fate. They were the result of risks that were visible to those who were willing to look beyond quarterly earnings. ESG investing emerged as a response to that blindness, an effort to systematically consider risks that were previously dismissed as non-financial until they very clearly became financial. However, this is where misunderstanding begins to creep in. Many investors treat ESG as a moral scorecard, assuming that high scores equal good investments and low scores equal bad ones. This mindset turns ESG into a blunt exclusion tool rather than a nuanced framework. A socially responsible portfolio built this way may feel comforting, but comfort is not the same as resilience. Excluding entire industries without understanding transition dynamics can lead to concentration risk. Buying companies simply because they are labeled green can result in overpaying for narratives rather than owning durable businesses. ESG, when simplified into virtue, signaling quietly undermines the very stability it claims to promote. A more mature view recognizes that ESG is about materiality. Not every environmental, social, or governance issue matters equally to every company. Water usage is critical for agriculture and semiconductors, but far less so for software. Labor practices are existential for service-based businesses, while governance structures can determine survival in capital-intensive industries. Socially responsible portfolios that perform well over time are built by investors who ask which ESG factors truly matter to the economics of each business, rather than applying a one-size-fits-all checklist. Measurement adds another layer of complexity. ESG data feels precise, but it often is not. Different rating agencies can look at the same company and reach opposite conclusions. One may reward transparency. Another may penalize the same disclosure for revealing unresolved risks. This creates a dangerous illusion of objectivity, where numbers are trusted without understanding how they were constructed. ESG scores should be treated as inputs for analysis, not verdicts. Blind trust in them replaces thinking with compliance, and markets are ruthless toward investors who stop thinking. Socially responsible portfolios also force investors to confront trade-offs. A company investing heavily in cleaner technology may suffer short-term margin pressure. A firm improving labor conditions may lose cost advantages. Governance reforms can slow aggressive expansion. These are not failures. They are choices with consequences. ESG investing does not eliminate compromise. It exposes it. The role of the investor is not to avoid discomfort, but to decide which compromises align with a long-term thesis and which introduce unacceptable risk. One of the most underestimated benefits of ESG investing is how it changes investor behavior. When you care about how a company governs itself, treats people, and manages long-term risks, you naturally extend your time horizon. You stop obsessing over noise and start thinking in cycles. This shift alone can improve outcomes, regardless of whether ESG produces excess returns in any given period. Socially responsible portfolios often succeed not because they are morally superior, but because they encourage patience, discipline, and ownership-minded thinking. Still, it must be said clearly, ESG is not a free pass. A well-governed, environmentally conscious company trading at an unreasonable valuation is still a bad investment. Responsibility does not override math. Cash flows still matter. Competitive advantages still matter. ESG should sharpen standards, not soften them. When investors allow values to replace valuation, they end up paying too much for comfort and too little for reality. The true role of ESG investing, then, is not to divide markets into good and bad actors, but to reduce blind spots. It is a tool for asking better questions, not for giving easy answers. Socially responsible portfolios work best when they are built intentionally with clear priorities, realistic expectations, and a willingness to accept complexity. When ESG becomes an identity instead of a framework, it drifts away from investing and toward ideology, and ideology has a poor track record of compounding capital. As ESG continues to evolve, the most important question is no longer whether it matters, but how it should be used without distortion. Because the line between meaningful integration and expensive distraction is thin, and understanding where ESG genuinely strengthens a portfolio versus where it quietly weakens, it requires a level of clarity, patience, and intellectual honesty that most investors underestimate, which brings us directly to the next part, where we need to examine when ESG investing strengthens a portfolio and when it quietly works against it, because this boundary is what separates disciplined integration from expensive self-deception. ESG strengthens socially responsible portfolios when it is used to identify risks and advantages that are financially material but underappreciated. Strong governance reduces the probability of catastrophic loss by aligning incentives, improving capital allocation, and limiting behavior that destroys trust. Environmental awareness matters when it protects assets from regulation, litigation, and physical disruption. Social factors matter when they influence productivity, retention, and customer loyalty. In these cases, ESG is not an overlay. It is part of understanding how a business survives and compounds over time. ESG begins to work against a portfolio when it becomes symbolic rather than analytical. Buying companies because they fit a narrative or excluding others without understanding transition pathways introduces hidden concentration and valuation risk. Many socially responsible portfolios unknowingly cluster in the same sectors, styles, and geographies, creating fragility disguised as virtue. Over time, this fragility shows up not as dramatic failure, but as persistent underperformance and disappointment. The market rarely punishes these portfolios loudly. It punishes them quietly through opportunity cost. Another critical distinction lies in engagement versus avoidance. Capital has influence only when it is present. Owning a company gives an investor a voice, however small, in governance, disclosure, and direction. Avoidance may satisfy conscience, but it often transfers ownership to those indifferent to outcomes. The most resilient ESG strategies recognize that improvement is as important as current perfection. A business moving steadily toward better practices can offer both impact and return, while a company that already scores perfectly may offer neither growth nor margin of safety. Time horizon again plays a decisive role. ESG factors unfold slowly. Governance failures incubate for years. Environmental risks accumulate before they surface. Social tensions build before they break. Investors seeking quick validation will conclude that ESG does not work, not because the framework is flawed, but because their patience is. Socially responsible portfolios are not designed to shine in speculative bursts. They are designed to endure full cycles with fewer permanent losses. As ESG investing matures, its edge will likely diminish. When everyone sees the same risks, those risks are priced in. But the disappearance of excess return does not mean irrelevance. Seatbelts do not make driving faster. They make survival more likely. In the same way, ESG integration may increasingly function as protection rather than performance. For long-term investors, avoiding ruin matters more than outperforming in any single year. The final and perhaps most important lesson is this: ESG investing cannot compensate for lack of clarity. Investors must decide whether they are optimizing for alignment, risk reduction, or return, and accept the trade-offs honestly. Confusion of purpose leads to portfolios that neither satisfy values nor deliver results. Clarity of intent, disciplined analysis, and humility about uncertainty are what allow socially responsible portfolios to function as intended. In the end, ESG investing reflects a broader shift in how capital understands responsibility and risk, not as opposing forces, but as intertwined realities. Used with restraint and rigor, ESG can help investors see what traditional models overlook and avoid mistakes that only become obvious in hindsight. Used as an identity or a shortcut, it becomes a costly distraction. The difference lies not in the letters E, S, and G, but in the mindset of the investor applying them. If this perspective helped you think more clearly about the role of ESG, rather than more emotionally, consider subscribing to stay with these long-form discussions that favor depth over slogans, and leave a comment, sharing your own experience or doubts about socially responsible investing. Because thoughtful reflection, not blind conviction, is what ultimately strengthens both portfolios and judgment.